So it's important to remember that in March of 2020, the Fed, for the first time ever, was buying credit, right? IG credit, and quite frankly, there were some double B, so high yield credit as well, as a way to get the markets moving. I don't know if they'll be able to do that this time around. So what does that mean? What that means to me is that you will have a more natural credit cycle where companies that are over levered, there's excess capacity for sure, given the fact that so many segments of the economies have been rescued throughout the years. And so I expect to see much more pressure from a credit perspective. I see defaults coming in a little higher than being forecasted. And I see this natural credit cycle that we haven't seen in quite some time. As corporates have really benefited from this low-cost debt environment. So they've added a tremendous amount of debt on the books at a low cost. That's the good news. That has led to, particularly here in the US, much more profitable companies. You have a tremendous amount of operating leverage built into these capital structures. But the reverse is also true. And so when those revenues start to decline, that high stock of debt starts to really weigh on those structures, and that could be a catalyst to much more pain and suffering on the credit side. So I think the credit side has some more room to go, so to speak, Simon.